Let me tell you something the IRS will never put in a letter to you, but that I'm going to put directly in front of you right now. The IRS does not warn you before you make a mistake. It doesn't send a notice that says, hey, before you take that withdrawal, here's what it's going to cost you in ways you don't expect. It simply waits. It processes whatever you submit. It applies the penalty if you've triggered one, and it moves on to the next return. The burden of understanding the rules, all 7 of the ones we're covering today, falls entirely on you. Vanguard research found that many retirees either get the timing or amount of their retirement distributions wrong, or don't plan distributions strategically, which can drive up tax bills over time. These aren't rare, unusual mistakes. They are common, predictable, and once you understand them, completely avoidable. This is Professor Kingsley, and today we are going through all 7 of the retirement tax mistakes that the IRS will never warn you about in advance, but that could cost you real money if you make them. Stay with me to the end. This is one of the most important videos I've made for this channel. Welcome to Professor Kingsley. If you're new here, this channel is built to take the tax and financial rules that matter most to retired Americans and explain them clearly, honestly, and without unnecessary jargon. If you find this kind of information valuable, please hit that subscribe button right now and turn on the notification bell. We release new content every single day, and the rules covered in this video are exactly the kind of thing that should be common knowledge among retirees, but rarely is. Subscribe now, and let's get into all 7 mistakes. Mistake number 1 is the one with the steepest penalty attached to it of anything on this list, and it's also one of the most preventable. It's missing your required minimum distribution, or taking less than the full amount required. If you don't take any distributions, or if the distributions are not large enough, you may have to pay a 25% excise tax on the amount not distributed as required, reduced to 10% if withdrawn within 2 years. Robert was already past his first RMD year and missed a $5,000 withdrawal for 2026. The IRS says he may owe a 25% excise tax, or $1,250, on the amount not distributed. If he corrects the shortfall during the correction window and qualifies for the reduced rate, the tax may be 10% or $500. The starting age for RMDs is 73. This change applies to individuals who reach age 72 after 2022 and age 73 before 2033. For those who attain age 73 after December 31st, 2032, the RMD age will rise again to 75 beginning in 2033. Once you hit that age, the IRS does not send you a reminder letter. It is entirely your responsibility and the responsibility of whoever manages your accounts to calculate the correct amount and take it by the deadline every single year. Your RMD is determined by dividing the balance in any given account at the end of the prior calendar year by your life expectancy as assessed by the IRS. If you're 75 and married, for example, the IRS says your applicable denominator is 24.6. If the balance in your IRA at the end of 2025 was $150,000, you would divide $150,000 by 24.6 years to get an RMD of $6,098 for 2026. If you took less than that, even by mistake, even because your account custodian gave you incorrect information, the penalty applies to the shortfall, not the total balance. But that shortfall penalty alone, at 25%, is one of the harshest tax penalties anywhere in the entire IRS code. If you missed a withdrawal or have inherited an account, consult a CPA. A professional can help you fix the mistake, calculate the missing amount, prepare Form 5329, and explain whether the IRS may waive some or all of the penalty. If you've already missed an RMD, even from a prior year, don't ignore it. Correct it as soon as possible. File Form 5329 and pursue the reduced penalty rate or a reasonable cause waiver. Mistake number 2 is one that catches new RMD takers, specifically people who are taking their very first required distribution and who make an assumption that seems perfectly reasonable but that has real financial consequences. John reached age 73 on August 20th, 2024. He must receive his 2024 required minimum distribution by April 1st, 2025, based on his 2023 year-end balance. John must also receive his 2025 RMD by December 31st, 2025, based on his 2024 year-end balance. Your first RMD must be taken by April 1st of the year after you reach age 73. For example, if you turn 73 in 2025, your first RMD can be taken as late as April 1st, 2026. If you wait until April 1st for your first RMD, you'll also need to take your next RMD by December 31st of that same year. That means 2 taxable withdrawals in 1 calendar year. This is the mistake of seeing the April 1st deadline as a benefit without understanding the cost it carries. A retiree turns 73, learns about the April 1st grace period and thinks, "Great, I'll wait." What often isn't explained clearly is that waiting doesn't actually save anything, it just delays the first distribution into the same calendar year as the second one. Large withdrawals can also push other income into higher tax brackets. 2 full RMDs hitting your taxable income in the same year can move you into a higher bracket, push more of your Social Security into taxable territory, and potentially trigger higher Medicare premiums 2 years later. Jean turned 73 in 2026. Her traditional IRA had a balance of $100,000 on December 31st, 2025. The IRS example table shows a 73-year-old using a 26.5 factor. Jean's 2026 RMD would be about $3,773.58. If she delays her first RMD until April 1st, 2027, that distribution is generally taxable in the year she receives it, which would be 2027. Most tax professionals recommend taking your first RMD in the actual calendar year you turn 73, specifically to avoid stacking 2 taxable distributions into the following year. Mistake number 3 is one of the most consistently misunderstood rules surrounding RMDs, and it relates to how you correctly handle distributions when you have multiple retirement accounts of different types. Using the wrong account rules. Roth IRA owners alive usually do not have RMDs, but traditional IRA owners do. Combining accounts the wrong way is a common mistake among retirees. The RMD for each year is calculated by dividing the IRA account balance as of December 31st of the prior year by the applicable distribution period or life expectancy. RMDs are not required for your Roth IRA. Here's the rule distinction that trips people up. For traditional IRAs, including SEP and simple IRAs, you calculate the RMD for each account separately, but then you're allowed to total those RMDs and take the combined amount from any one IRA, or any combination of them. You don't need to take a separate withdrawal from each individual IRA account. But for employer-sponsored plans like 401k accounts, the rules are different. Roth IRAs work differently. They are not subject to RMDs during the original owner's lifetime. If you have multiple old 401k accounts from former employers, you generally must calculate and withdraw the RMD from each one individually. You cannot combine them and take the total from a single account the way you can with IRAs. You'd still have to make withdrawals from any IRAs or other non-workplace accounts, as well as from older 401k accounts that haven't rolled over. Missing this distinction, assuming you can combine RMDs across all your accounts the same way, regardless of account type, can result in an under-withdrawal from one of your 401k accounts, triggering the penalty on that specific shortfall, even if you took more than enough from your other accounts. Mistake number 4 is the one that creates the most expensive long-term consequences for the families involved, and it relates to inheriting a retirement account from someone other than a spouse. Secure Act rules significantly changed RMD requirements for non-spouse inherited IRAs. Missing or miscalculating an RMD can trigger penalties of up to 25%, reduced to 10% if corrected promptly. Most non-spouse beneficiaries inheriting an IRA from someone who died after 2019 must fully distribute the account within 10 years of the original owner's death. For defined contribution plan participants, or IRA owners who die after December 31, 2019, the entire balance of the deceased participant's account must be distributed within 10 years. There's an exception for a surviving spouse, a child who has not reached the age of majority, a disabled or chronically ill person, or a person not more than 10 years younger than the employee or IRA account owner. The new 10-year rule applies regardless of whether the participant dies before, on, or after the required beginning date. The mistake comes from a misunderstanding about whether annual distributions are required during that 10-year window. If the original IRA owner had already started RMDs before death, IRS guidance requires beneficiaries to continue taking annual distributions during the 10-year period, not simply wait and withdraw everything in year 10. Skipping these inherited RMDs can trigger penalties, a common trap for beneficiaries. Although distributions from an inherited Roth IRA are usually tax-free, the account must still be emptied by the end of the 10th year after the original owner's death. Unlike inherited traditional IRAs, annual RMDs are typically not required for inherited Roth IRAs during years 1-9. However, failing to fully withdraw by year 10 can lead to IRS penalties. If you have inherited an IRA from a parent or anyone other than a spouse, please consult a tax professional before taking any action with that account. The rules differ significantly based on the relationship to the deceased, whether the original owner had begun RMDs, and the type of account and the consequences of getting it wrong are significant. Mistake number 5 is the one that creates the most invisible and most underappreciated tax cost in all of retirement planning, and it involves the relationship between your IRA withdrawals and how much of your Social Security gets taxed. Up to 85% of Social Security benefits might be taxable, depending on your combined income. Other retirement income, such as IRA withdrawals, pensions, or investment dividends, increases that amount, which can make more of your Social Security subject to federal income tax. Combined income equals AGI plus non-taxable interest plus half of Social Security benefits. Even a modest 401k withdrawal could push you from 50% to 85% of your benefits being taxable. Suppose a single retiree receives $20,000 in Social Security and $15,000 from IRA withdrawals. Their provisional income would be $20,000 divided by 2 plus $15,000 equals $25,000, putting 50% of their Social Security benefits into taxable income. If they withdraw $10,000 more from their IRA, their provisional income rises to $30,000, and up to 85% of benefits could become taxable. That's the mistake treating an IRA withdrawal as if its cost is limited to the income tax on the withdrawal itself, without accounting for the fact that it can also pull more of your Social Security into taxable territory simultaneously. Tax tip: monitor your combined income. Consider timing withdrawals from taxable accounts to reduce the taxable portion of your benefits. Tax tip: plan withdrawals strategically. Splitting RMDs across multiple accounts or timing them in lower income years can help manage your tax burden. This rule has not changed, despite a common misconception that it has. You might have heard that the Trump/GOP 2025 tax and spending bill eliminates taxes on Social Security benefits. It does not. The new law doesn't change the Social Security benefit tax formula or the IRS combined income thresholds. But the 2025 tax bill contains a new tax deduction for older adults beginning with the 2025 tax year. Retirees age 65 plus might be eligible for a senior bonus deduction of up to $6,000 or $12,000 for joint filers. That's even if they take the standard deduction or itemize. The deduction is real and valuable, but it does not change the underlying combined income formula. Treating these as the same thing is a planning mistake that leads to inaccurate projections. Mistake number 6 is one that catches retirees by surprise, specifically because it happens silently in the background, and most people don't discover it until they see their actual tax bill at filing time. It's underwithholding on retirement distributions. Always check the tax withholding. Come tax time, you may owe a lot, says Kevin Martin, manager of the Tax Institute at H&R Block. By default, it's usually 10% withholding. Depending on the size of your accounts, that may not be enough. Most IRA custodians default to withholding just 10% of a distribution for federal taxes, unless you specifically instruct them otherwise. For a retiree in the 22% or 24% tax bracket, that 10% default withholding falls far short of what's actually owed, meaning that when tax season arrives, they're facing a much larger bill than they expected, and potentially an underpayment penalty on top of it. The fix is straightforward, but requires action. When you take any retirement distribution, especially your RMD, instruct your custodian on the specific withholding percentage you want applied, calculated based on your actual marginal tax bracket rather than accepting the default 10%. Similarly, if you're receiving Social Security and haven't elected any withholding, you can request federal tax withholding directly from your Social Security payments using Form W-4V, choosing a rate of 7, 10, 12, or 22%. Proactively managing your withholding throughout the year prevents the unpleasant surprise of an unexpectedly large tax bill in April. Mistake number 7 is the one that requires the most discipline to avoid, because the temptation runs counter to it, and it's converting too much traditional IRA money to Roth in a single year without considering the full tax consequences of doing so. Though moving money into a Roth IRA can eliminate future RMD requirements, the converted amount counts as taxable income in the year you make the move. A large one-time conversion can trigger a major tax spike and even have knock-on effects beyond your tax bill. It can push more of your income into higher marginal brackets, reduce eligibility for certain tax credits and deductions, and even increase the portion of your Social Security benefits that are taxable. In some cases, it can also trigger surtaxes or phase-outs that many retirees don't see coming. Spread out Roth conversions. Converting traditional IRA funds into a Roth can reduce future RMDs, but the Internal Revenue Service treats each conversion as taxable income in the year it's made. Spreading conversions over multiple years can help manage your tax bracket and avoid a sudden spike. This is the rule that the convert it all at once approach gets wrong. Roth conversions remain one of the most valuable retirement tax strategies available, particularly when executed in the years before RMDs begin and Social Security has started, but their value comes from careful sizing within your current tax bracket, not from aggressive lump sum conversions that push your income into territory you didn't intend to enter. A retiree who converts $200,000 in a single year may save significantly on future RMD taxation, but in doing so, may trigger a temporary spike that pushes them into the highest brackets, triggers the highest tier of Social Security taxation, and creates an IRMAA surcharge on their Medicare premiums 2 years later costs that, combined, can offset much of the benefit the conversion was meant to provide. Use charitable giving to reduce taxes. A qualified charitable distribution allows you to send money directly from your IRA to a charity, which can lower your taxable income while supporting causes you care about. This is the complementary tool to Roth conversions, and one that doesn't carry the same risk of a bracket spike, because QCDs are entirely excluded from AGI rather than added to it. Now let me give you the comprehensive action plan that ties all 7 of these mistakes together, because understanding them is only valuable if it leads to better decisions going forward. Action 1. Mark your RMD deadlines clearly. Check whether you turn 73 in 2026 or are already in an RMD year. Pull your December 31st, 2025 retirement account balances. Confirm which accounts have RMD rules and which do not. Mark your RMD deadline on your calendar now. Don't rely on memory or assume your custodian will remind you in time. Take ownership of the calendar. Action 2. If this is your first RMD year, strongly consider taking your distribution within the calendar year you turn 73, rather than waiting for the April 1st grace period, specifically to avoid the double distribution problem in the following year. Action 3. Understand the aggregation rules for your specific accounts. IRAs can generally be combined for RMD purposes. 401k accounts generally cannot. If you have multiple old 401k accounts from former employers, consider whether consolidating them into a single rollover IRA might simplify your future RMD calculations and reduce the risk of an accidental missed distribution. Action 4. If you've inherited a retirement account from anyone other than a spouse, consult a tax professional before taking any distribution action. The 10-year rule, the potential requirement for annual distributions, and the differences between inherited traditional and inherited Roth accounts are complex enough to warrant professional guidance. Action 5. Before taking any significant IRA withdrawal, calculate your combined income, your AGI, plus non-taxable interest, plus half your Social Security benefit to understand whether that withdrawal will push more of your Social Security into taxable territory. Time discretionary withdrawals, where possible, to stay within lower combined income tiers. Action 6. Review your withholding elections on every retirement income source: IRA distributions, 401k distributions, pension payments, and Social Security. Don't accept the default 10% withholding without confirming it's adequate for your actual tax bracket. Action 7. If you're considering a Roth conversion, size it carefully within your current tax bracket rather than converting a large amount all at once. Spread conversions across multiple years where possible, and model the impact on Social Security taxation and Medicare IRMAA thresholds before executing. Here is what I want you to carry away from everything we've covered today. Every one of these 7 mistakes is preventable. None of them require complicated financial engineering or expensive professional services to avoid. What they require is awareness, exactly the kind of awareness this video has given you. RMD planning should never be done in isolation. With the right guidance, RMDs don't have to be a burden. They can become a key part of a well-designed plan that protects and maximizes your retirement wealth. The IRS will never call you to warn you about any of this. It will never send a friendly reminder before the deadline passes or before the combined income threshold is crossed. The system is built to collect what's owed, not to optimize what you keep. That responsibility and that opportunity belongs entirely to you. Before you close this video, please do 2 things. First, share it. Think of one person in your life who is retired, approaching RMD age, or has recently inherited a retirement account. A parent, a sibling, a close friend. Hit that share button right now and send this video to them. The 7 mistakes we covered today are exactly the kind of information that could prevent a costly, painful tax surprise. And that's worth 3 seconds of your time. Second, drop a comment below. Tell me which of these 7 mistakes hit closest to home for you. Are you approaching your first RMD year and rethinking your timing? Have you inherited an account and you're unsure about the rules? Are you reconsidering a Roth conversion strategy after hearing today's video? I read every single comment, and your situations and questions shape exactly what I cover next on this channel. This is Professor Kingsley. Stay informed, stay ahead of the IRS, and I'll see you in the next one.